Good morning and good afternoon, everybody. Thank you for joining us here for our continued series, a webinar series around estate planning, financial planning, and investment management with Miracle Mile Advisors. Uh, Joining me today is Blake McKibben. He is our estate planning attorney, over 2 decades as an estate attorney now, and won't give you his age, but you can start to guess. And again, for those of you that don't know me, my name is Nate Angelo, and I am the head of wealth management here at Miracle Mile Advisors. And would just say that we are super grateful for the opportunity to serve you as clients, to partner with some of you as who serve in an advisory capacity for clients, either as CPAs or attorneys in their lives. And for those of you that may not know us and are joining us for the first time, we are here to truly add educational insights and hopefully some value to you as you think about your estate planning and some of your giving strategies more specifically. But before we jump into today's content, I thought I would just take a second to walk you through some of the ways we think about engaging clients and specifically the planning topics that we like to talk with clients about. And so when we think about wealth management and financial advisors, a lot of the financial advising firms talk about quote unquote financial planning and or holistic wealth management. Those are some of the buzzwords. But we really like to try and break that down and make it tangible. And so when we think about our client relationships, we start from this perspective of goals-based investing and goals-based financial planning. And so the root of what we do is trying to understand what it is our clients are trying to accomplish in life. And so we take a very big picture when we start these conversations, and then we begin to zero in helping clients identify clear goals. And sometimes those are life goals, sometimes those are business related goals for our business owner clients. Sometimes those are how do you navigate income needs as you approach and enter into retirement. Sometimes it's college funding, it's second homes, it's budgeting, it's managing a balance sheet. And so we take this high level approach to financial planning and then we zero into key areas that apply to our clients. And so I mentioned next generation education, balance sheet forecasting, consolidated performance reporting, risk management, cash flow planning. So all of these things are important to the overall wealth management process for us with our clients. And one of those areas of focus are wealth strategy and liquidity planning. I think for many of us, when we think about the future, we think about our legacy, we think about our family, we think about friends, we think about the philanthropic giving and or the charities that we want to contribute to beyond our existence here. And so today we are going to explore another area in this broader wealth strategy and liquidity planning bucket, if you will. And so Blake is going to walk us through some various concepts. He's going to share some broad insights into what goes into charitable giving and some of the tax benefits and said another way, what are some of the tax efficiencies that might be gained as you pair your passions and your interests with purposeful giving. And so with that, Blake, thank you for being a great partner and serving our clients. And it's great to work alongside you. And I'll turn it over to you.
Thank you so much, Nate. Yeah, thanks everyone for joining today. I'm really excited about being able to speak on this subject. You know, as an estate planning attorney, I talk about death all the time and it gets old. But what is really fun is talking about charitable planning, leaving a legacy, supporting your community and the causes that you love. And so, you know, today we're biting off a huge topic. We're just going to be here for the next 25 minutes or so. But please, you know, we're going to do real high level overview. But if anything rings true, or you want to learn more, please contact your Miracle Mile advisor, and I'm happy to have a conversation with you on an individualized basis. So, as we begin today, I'm proud to say it's not often that you look and you say, yes, I am absolutely proud to be an American. You know, there's a lot of bad rhetoric and things going around right now, but when you look at charitable giving, we as Americans lead the world in charitable giving. And there's just some fun stats here from CAF America, but over the last 10 years, 72% of Americans helped a stranger, 61% of Americans gave money to charity, and 42% of Americans volunteered their time. Now, I was listening to a news program a few years back, and I thought it was really interesting um, that, con artists, they tailor fit their cons that they're doing based on the country that they are trying to con out of money. So if a con artist is working and trying to get money from the Japanese, they will talk about shaming and, hey, I'm going to disclose this information and blah blah blah. And so it's very interesting. But the con for the United States, and I'm sure that we've all received emails like this, is about charity. Hey, there's an African prince, or there's someone that needs money, and can you send money overseas, or things like that. So, it makes you proud to be an American that we are a very, very generous community and society. One thing that's interesting, though, is that we give during our lifetime, but it's not necessarily represented in our estate plans. I think that's missing a huge opportunity. So the National Philanthropic Trust said that of the total, about 417 billion was given to charity in 2023. Only about 10% of that was given at someone's death. The Sharp Group notes only about 5 to 8% of people at death include charity in their estate plan. Now, here's the thing. We're going to talk about this in the next coming slides, but the 61% of Americans who give to charity, the vast majority are not getting any tax benefits for doing that. So while we're alive, we're giving money to charities and supporting causes, but then at death, it's interesting that we just don't. And I wonder if just little education and things like that can go a long way. And so that's why I'd like to have this discussion today. We're going to talk about charitable giving while we're alive and at death and everything in between. So here's the 2024 tax brackets. Now, yesterday, or the day before yesterday, the IRS announced 2025 tax brackets, but arguably nobody cares about those until after April 15th of next year, right? So I just want to bring this into light, in context, because as you think about it, pretty, really amazing low tax environment right now. And as you look, and I was just doing a little bit of research, and the federal estate tax started in 1916. I believe that the capital gains tax was enacted in about 1912 or something like that. Now, if you look at the capital gains tax rates over time, we average about a 25% capital gains tax rate. On average, right? And what's interesting is you look here in this column, married filing jointly, which is the vast majority of single, married filed separate, had a household. But these first two columns here, a married couple can receive about $384,000 of income and still be in the 24% tax bracket. That's for ordinary income. So just put that in context. Over time, we are in a very incredibly low tax environment. Now, yes, there's changes that are on the horizon in the future. And we'll talk about, we're going to do a webinar after the election and when things are settled out. And unfortunately, it's not going to be the day after the election this time. And we've talked about the estate tax changes that could happen after our current tax law expires at the end of 2025. And it's pretty stark. It's also incredibly stark when you look at the income tax changes. I think estate taxes gets the headlines, but income taxes are something that are going to impact us from day one. None of us are planning on dying anytime soon, right? So this is incredibly important. And I just want to draw you back to this. So today's tax rates are over there on the right side of 2024. And then I've got 2017 tax brackets right next to it. So the idea is if we go off of this cliff at the end of 2025, we're going to revert back to what 2017 tax brackets were. They'll be adjusted for inflation. So this isn't a true depiction of what they might be, but it's pretty darn close. Now, as you look today in 2024, our top tax bracket is 37%, and it doesn't apply until, as we said the slide before, over $730,000 of income. Well, in 2017, if that comes back, the top tax bracket is 39.6%, and it starts below $500,000. So we're going to, if we go over this cliff, we are going to feel it in our pocketbook. That's for sure. And I once again, I draw your attention back to that 24% bracket. You can make almost $400,000 in today's world in the 24% bracket. Whereas if we revert back, you're going to be in the 33% bracket. And if you listened, and we're not here to scare anybody or anything like that, but a while ago, Biden was talking about his idea is, hey, anyone over $400,000, that's where the top tax bracket should apply. Now, that's neither here nor there. What we're worried and I'm worried about a peaceful transition of our government, but what we're watching and what we know, what we understand, history in the past is going to repeat itself, and then there won't be any tax law that gets passed unless there's one party that's in control of the House, the Senate, and the presidency. So that's why we're closely watching these elections. If there's any one party that's not the full, then more than likely we're going to go off of this cliff. So let's talk about some taxes, tax credits, tax deductions, what all about the charitable benefits of giving. But before I do that, I just wanted to do an apples and oranges comparison here, okay? Because sometimes we get confused about what a charitable deduction actually is. Now, a tax credit, is something that reduces your tax burden dollar for dollar. So for instance, if you had a $5,000 tax bill you had to pay at the end of the year, and you had a $3,000 tax credit, that dollar for dollar reduces your tax bill. So you'll owe $2,000 in that scenario. But a deduction, which we're talking about charitable giving, charitable deductions, it's a lot different. A deduction reduces the amount subject to income taxes. Okay, so for the same example, if you have a $5,000 tax bill, but you've given $3,000 to charity, generating a charitable deduction, well, if you're in the 32% federal tax bracket, you're only getting a tax benefit. Well, not only, it is nice, but it's $940. And so you still owe $4,040 in taxes. And so that's one thing that often gets overlooked if people think, oh, well, I'm going to give this to charity. It's going to reduce my tax bill dollar for dollar. No, it doesn't. It reduces the amount of your income that's subject to income tax. And so at the end of the day, it does cost money in order to make a charitable gift. But if you're charitably inclined, it's absolutely worth it at the end of the day. Now, moving on, this, as we talked about, changes in the tax laws, the Tax Cuts and Jobs Act passed at the very end of 2017. What it did is it doubled the standard deduction at that time. Right now, the doubling of the standard deduction, what they also had to do, part of the trade-off, was they eliminated a lot of the itemizations that you can use on your taxes in order to itemize your deduction and get those benefits. So as we look, standard deduction 2024, 14.6 for single filers, just over 29,000 for those married filing jointly, which means over 90% of Americans are taking the standard deduction in the last few years as this tax law has been around. What that means, as we talked about, over 60% of Americans are giving to charity, right? Well, they're doing so, but they're not getting any tax benefit from that because if they're not itemizing their deductions, they're just taking their standard deduction, well, then there's no charitable deduction that they get to take on their taxes. Now, change could be on the horizon, absolutely, and we're definitely going to be monitoring that, and that'll be another subject of another webinar that we'll do after the election or once these things become more clear. But as it goes, for 2024 and 2025, the next two tax years, each year is a math exercise. We're just trying to figure out, hey, am I going to take the standard deduction or am I going to itemize? Well, if you're looking at, if you want to itemize, you've got really four main levers to pull. First is the state and local income tax deduction, but that's limited to $10,000. And then you can also itemize your mortgage interest. And then you can itemize medical expenses, but those are only medical expenses that exceed 10% of your adjusted gross income. And then you've got charitable gifts. So if those add up more than $29,200, you're going to itemize your taxes. But for a lot of families, right, maybe they maximize state and local income tax, but maybe they don't have a mortgage. Maybe they don't have medical expenses. Well, in order to itemize taxes, they'd have to give a lot in charitable gifts. So what we see, like I said, over 90% of people are taking the standard deduction. Now there's ways, and we'll kind of talk about this as we go through today, of maybe I make a bunch of gifts in this tax year, and then I don't make any next year. We call that bunching. And I'm going to talk about the concept of a donor advised fund here in a little while, but that's something that has really sprung to the forefront during this tax law's lifespan. As hey, let's put a bunch of taxable gifts in one year, and then the next year the year that we make these gifts we'll itemize. The next year we won't, and we'll take the standard deduction and on down the line. So. It's goofy, and it's going to be even goofier in the future when the new tax laws or whatever shakes out of this next administration. Now, as we think about giving, we've talked about giving to individuals, right? When you give to family, friends, things like that, all those gifts have limits associated with them. However, there's four little facets that I want to touch on that are gifts without limits. Now, those are gifts between spouses. Gifts between spouses, actually, before 2000, there was a limit. You could only give $600,000 to your spouse. Well, they did away with that. So now you can move as much money back and forth between spouses as you'd like without any limits to that. Now, another gift without limit are doctor bills. If you pay someone's doctor bills directly to the source, there's no limit on that. And it also doesn't count as a gift that you're giving to the person that you're helping to pay their doctor bills. So that's a gift without limit. Another gift without limit is education expenses. Now, these have to be paid directly to the institution. You can't just give it to your grandchild and think that they're going to turn around and pay the tuition with it. You have to go directly. And going direct, once again, no limits. And I think last time I checked, Ivy League are about $75,000 a year. So that can add up to a lot. No limit. The other one is charitable gifts. There's asterisks there, because yes, you can give everything away that you own without limit. There's no limit. However, there's limits on what you can deduct. All right. So as we think about these deductibility of your charitable gifts, what matters is the type of asset that you're looking at giving. And so if you and the recipient of that. Now, if you make gifts of cash directly to a charity or to a donor advised fund, you can write off up to 60% of your adjusted gross income. Adjusted gross income, that's really everything that you've made in that year, minus some small things like 401k contributions and things like that, right? So you can write off up to 60% of what you've made for cash gifts. So if I made $100 this year, I can make a gift of $60 in cash to my favorite charity. I get to write off that entire amount. Now, if I want to make a gift of $70 and I've only made $100 in the year, I can write off $60, and then that extra $10 actually get a bank, and I can use that for 5 more successive tax years to completely use up that entire amount. So that's gifts of cash. Now, how about gifts to a private foundation of cash? Well, the limit is lower. It's 30% of your adjusted gross income. Now, we're going to touch briefly on private foundations here in just a little while, but typically, the government thinks, hey, there's a lot of family control on those private foundations, and there might be a way that you're compensating your family members for sitting on the board of directors. So that's why the limit is lower on those contributions to that private foundation. Now, gifts of appreciated securities, and we're going to talk about the tax benefits of that in just a few slides here. Gifts of appreciated securities, you're limited to 30% of your adjusted gross income when you give it directly to charity or to your donor advised fund, whereas it's only 20% when you give to a private foundation. Once again, it's because you have a lot more control in those private foundations. Now, best assets to give. I'm going to start with the best, hands down, IRAs. If you're thinking about passing IRAs on as a generational asset, think again. Unless you convert it to a Roth IRA. But any asset that's a 401k, SEP, profit sharing plan, whatever it is, ordinary income taxable items, those are things that can get taxed twice. Once at your death as part of your estate, and then again when it goes to your heirs. So the best recommendation these days is to use IRAs as your bucket for charitable giving. Go reach into there first to distribute funds to your favorite charities. Now, while you're alive, you're limited. Now, while you're alive, you have to be over 70 and a half years old. It's different. It used to be the same as when your required minimum distribution started. Well, now required minimum distributions don't have to start till 73 and up. But to make a qualified charitable contribution, you must be 70 and a half and a day. It's not the year you're going to turn 70 and a half. You have to be 70 and 6 months and a day. Now, you can do this up to $105,000. Now, that's actually something that's new for this year. It used to be limited to just $100,000, but now they've added a little inflation adjustment. Now, why would you do a qualified charitable distribution? Now, let me just say before I get into that, when you make these, it's directly from your IRA to charity. It does not work to go from your IRA to a donor advised fund. That does not work. While you're alive, that does not work. That actually works at death, but not while you're alive. So you have to go directly to a charity to get this treatment. So why would you do it? Well, first of all, it helps to satisfy your required minimum distributions. Right? If I have a required minimum distribution this year of $200,000, well, I can take $105,000, give to my charity, and then I only have to take an extra $95,000 of my required minimum distribution. And what's important is that now, when I take my 95 instead of my 200, I'm only reporting $95,000 as ordinary income. I'm not reporting 200 as ordinary income. That's the important thing. Now, on top of that, as we talked about, the vast majority of people, they don't itemize their deductions anymore. We're just taking the standard deduction. So when you make this gift, the qualified gift directly from your IRA, you're able to get the same tax benefits because that goes directly to a charity is not something that you're going to have to pay tax on or recognize as income, which has other cascading effects, right? Your Medicare Part B premiums, the taxation of Social Security benefits and the medical deductions that you can take. All of those are income specific. And so if you're able to take $105,000 that you originally would have had to take and count as ordinary income, this reduces what your income is for the year, reducing the taxation of Social Security, Part B premiums, and helps you make that 10% floor on those medical deductions even more beneficial. So this is the by far and away best way while you're alive to make distributions and support your favorite charities through this. But have to be 70 and a half. You can't do it beforehand. You have to be 70 and a half years old. Now, thinking about this after death, as I said, at death, right, you can give your IRA to your private foundation or your donor advised fund or to charity and the like. But here's what I see all the time. I will see a scenario where mom and dad want to give a gift to charity at their death. And they've got an IRA and they have their other assets, right? And so typically what I see is they'll say, yeah, we want to give a $100,000 gift to charity at our death. And so what they'll do is they'll state that inside of their will or inside of their trust. And then their IRA, they have the beneficiary designation set up. Oh, it's just going to go to my kids. Well, here's what happens there. If your children inherit your IRA from you, they have to pay ordinary income tax on that. And so if they're in a 40% combined tax bracket, at the end of the day, they're left with $60,000. Whereas charity, they're happy. They'll take money, right? And so if they inherit stock through your will or through your trust at your death, well, what happens? Yeah, stock gets a step up in basis, right? Whatever you purchased a stock for, right? That's your basis. If it appreciates in value and you sell it during your life, well, you have to pay capital gain. But at your death, there's a step up in basis. So let me tell you, this is the wrong way to do it. Flip it. If you flip it, everybody is happy. Charity, they'll take the IRA. They don't pay any income tax. So charity, if they inherit $100,000 from your IRA, they're happy. They still get $100,000 at the end of the day. If your family inherits stock through your estate, well, then that stock is going to get a step up in basis. And so they're going to receive $100,000 and not have any income tax on that. So, as I said, the first bucket that you ever want to go through for charitable giving is going to be IRAs. Hands down, without a doubt, IRAs. Now, if you're under 70 and a half, or if you don't have much in IRAs, well, the second best item is going to be appreciated securities. Right? So appreciated securities, let's say that you want to donate 100 shares of widgets. Use your imagination. You bought the shares for $100 total, and today they're worth $1,000. So let's do the scenario. Well, what if you sold the shares and then took the remaining cash and then you donated that to charity? Well, if you did that yourself, you'd have to pay the capital gain when you sell those shares, right? The capital gain, you have $900 capital gain. You've got 15% tax bracket, maybe higher. So you have to pay $135 in taxes, leaving you with $865 to donate. So you donate that, you receive an $865 donation. However, if you donated those appreciated securities directly to your donor advised fund, to your private foundation, or directly to charity, well, much better tax result, because you're not selling that asset yourself. You're taking that asset and donating it directly to charity. The value of your gift is the fair market value of those shares. So you're making a gift of $1,000, and that's your charitable deduction for that tax year that you made that gift. And so you think back of, oh, okay, I get it now, right? There's limits if you give cash to charity up to 60% of your adjusted gross income. And if you gift appreciated securities, you're limited to 30% of your adjusted gross income. That's because of the good tax treatment that you get. So that's some fundamentals. That's just some nuts and bolts. Now, this is where we can get lost really fast. And Nate, keep me honest. I get a little excited when I talk about these things. I'm going to try to go through these and really just be high level, because using any of these strategies is definitely based different family by family. So just real high level, I want to highlight just a few things here today. The first is a donor advised fund. And I've been talking about this a lot, right? So the donor advised fund is something that is very simple to set up. And it's very easy to manage. And so you've got higher deductions and the like. And this is really what a lot of families are gravitating towards, especially while they're alive. This makes a lot of sense for a lot of people. Whereas the next one, and don't get lost in the words here because I'm going to compare and contrast this directly with a private foundation. Now, a private foundation has a lot more working parts. It's a lot more cumbersome to maintain and keep up and running and going. And so when you think about it, I think, and I would put at least $3 million into a private foundation to make it worthwhile. Any amount below that, I just say, just do a donor advised fund. It's going to be so much easier. But when you start getting higher dollar amounts, or thinking about posthumously how you can do things for your family at your death, it's going to be funded a lot more at your death. A private foundation might be the place to do it in. So here's my comparison chart. Okay, so I didn't want to get lost in the weeds yet, but here's what I want to get into. So as you think about these, as I said, donor advised fund, it's a lot easier. Private foundation, a little bit more complicated. Well, why? Well, first of all, does it require an attorney to establish? A donor advised fund does not. You just find a provider and you fill out paperwork and away you go and you're done. However, if you create a private foundation, yes, you will have to have your attorney create those documents for you, and you'll either do it in trust form or corporate form. If you want to talk about that, I'm happy to do that. Now, next part, taxes. Well, what if and we want our charitable dollars to grow in value? Well, does it have to pay taxes? Well, donor advised fund, no. So the money's in there. It can grow to whatever, and there's no tax implications of that. However, a private foundation must pay a 2% tax on your investment earnings. Now, are there required distributions from a donor advised fund? No, there are not. A donor advised fund provider might have their own, say, hey, you want to distribute so much every so often just to keep your fund active. However, a private foundation must distribute 5% of its assets every single year. Now, going down the list, deduction limits for cash, you said donor advised fund, 60%, private foundation is lower at 30. Appreciated securities, we've got 30 and then 20 for that private foundation. Now, this is an important one. This is what I really want to get to. Anonymity. Can you be anonymous? Through the donor advised fund? Absolutely. That's a big point. So when you make a grant from your donor advised fund, you can decide to do that with your name or your family's name attached to it. Or you can decide to make it anonymous. In today's political climate and all these different causes and the like, it's nice to have the option to not put my name associated with that if there could be repercussions or something down the line. Some people don't care about it, but others, absolutely. Private foundation, however, no, it's not anonymous. Gifts carry the foundation's name. And on top of that, I said, the private foundation has to pay taxes every year. That tax return is going to list the total amount that's in the foundation, and it's going to list all of the members of the board on that. That becomes public record. And anybody with an internet connection can go on and look at how much money is in this foundation and can start trying to call all of the members of the board requesting money. Okay. So anonymous, not so much with the private foundation. However, who has the edge for the ultimate control? Well, that actually goes for the private foundation. So with the donor advised fund, you make requests to the donor advised fund provider to make grants to your favorite charities. Then it's up to the donor advised fund provider to live up to those expectations, make those, or they can say no. In my experience, I've never seen any donor advised fund providers say no. And in fact, if you go with a donor advised fund provider that says no, they don't want to make that gift, guess what? You can make a gift of your total account value over to another donor advised fund at another provider. And then you can make your gift over there. So ultimately, yes, you're at the whim of the provider. However, you don't have ultimate control. Whereas through the private foundation, absolutely, it's the foundation, it's the board of directors that are making those gifts, and it's nothing, no outside part at all. There's another one. Can you compensate family members for carrying out the organization's purpose? You think about that. A lot of what you're doing with your donor advised fund with a private foundation is looking into your community and trying to figure out what are some good causes that I want to make donations to. It can take a lot of time and effort in evaluating these things. There's whole industries, and I've got several people that I've worked with, and one's a neighbor of mine that you can employ them, and he'll come and you say, hey, here's my specific area that I want to donate to. And he will go and research and find you 5 charities that do exactly what you want to do, helping you to make those decisions easier. But at the end of the day, it does take time in order to evaluate and things like that. A donor advised fund does not allow for any compensation of family members for their time. However, a private foundation does allow you to do that. Now, it has to be reasonable compensation. So, pigs get fat and hogs get slaughtered. So you gotta, be very, very careful as you're doing that. But now as you're thinking of this, you're thinking, well, geez, yeah, there's pros and cons to both. Well, guess what? You don't have to pick one or the other. A very real example of this, when I was in Houston, Texas with Merrill Lynch, there's a family I was working with that they sold their business for over $500 million, and they wanted to give over $100 million to charity. So what they did, what they structured was ingenious, and it's something that I use this as my example every single time it comes up. So they created both a private foundation and a donor advised fund. And the way that they did it is they parked the vast majority of funds in the donor advised fund. And they did it that way because those funds that will grow inside that donor advised fund, there's no taxes, there's no tax return or things like that. And so they had just a small amount that they had in their private foundation, which was okay. People going and through the 990 PS, the tax returns, are saying, you know what? There's only $10 million in this charity. Well, guess what? The way it was structured, the private foundation owned the donor advised fund. And so the private foundation was really controlling $100 million, even though there was only technically $10 million in that private foundation. And so you can combine the two. And so that family, what they were doing is, hey, every year that 5% that had to come out of the private foundation, they just kicked that over to the donor advised fund. Anytime that they made gifts, it came out of the donor advised fund. So yes, absolutely, you can get the best of both worlds. Of course, though, we're talking about some serious charitable dollars that you want to put in place. So, but this is where I said I can get carried away. This is really fun for me to talk about. Now, I just want to touch on just a couple concepts as we end here today, and these are things I want to touch on. A charitable remainder trust. Now, this is a way that you can make a charitable gift, receive a charitable deduction, but also receive an income stream for the rest of your life. Now, this is something that is very interest rate specific. And as interest rates go up, this is way more beneficial for clients. As interest rates go down, not so much. Still beneficial. So this is, let's say that we have $1 million of highly appreciated stock. Or let's say that we've got some business assets, maybe some machinery or equipment that we've fully depreciated the value of that. And we don't want to sell that ourselves because that's $1 million of ordinary income tax. So what you can do, you can create a charitable remainder trust. The steps are you create the trust, you place the assets into the trust. The trust then can sell those assets or do whatever they want. It's essentially like an IRA because inside of that trust, it's a charitable entity. So it's able to sell everything into a diversified basket of securities. And there's no tax bill when that happens. So the idea is when you make that gift, you're retaining a lifetime income stream. You can do it for a term of years and things like that. And this is where we can really get in the weeds, but I just want to give you the overview. So let's say a couple age 65 puts $1 million into that the charitable remainder trust. While they're alive, they're going to receive income every single year of about $70,000. Then when they died, whatever's left goes outright to their donor advised fund, their charity, private foundation, you name it. And so at the end of the time, it'd be about $921,000 that will go to charity. Now, the income tax, the benefit from this, the charitable deduction, is based upon that eventual gift that will be going to charity. And this is where interest rates come into play because it's really the time value of money of, okay, what's it going to be when we die? And if the interest rates are high, we're going to make that a larger amount. If interest rates are low, it's not going to be as big. And so for doing this, they're going to hang on to the annual $70,000 of income, and they'll be able to take as a charitable deduction just over $200,000 in this tax year. And of course, if they don't use it all up, they can roll that over into successive tax years. So this is something that, we look at our tax year and our assets and we'll take stock and decide if this is important or not. Now, real quick, I want to talk about this one's twin. Okay, this twin is the complete and utter opposite. So the charitable remainder trust, charity had to wait until after death to receive their funds. Now, this one's the complete opposite. So this is where you create this charitable lead trust, you place your assets in there, and then you set up a term of years for that trust. You can do it different ways too, but typically you'd set it up for 20 years. And so you say during the term of the trust, the income is going to be distributed out to my donor advised fund, to my charity, or private foundation and the like. And then after that term of years is over, whatever's left in that trust reverts back to your family. So as we think, I'm from Iowa, one of our sayings is that this is like giving away the milk from the cow, but the cow comes home at the end of the day, right? So just giving away the milk and not the cow. That's the idea. Now, these, unlike their opposite twin, these are very effective when interest rates are low. So these were amazing a couple of years ago. They're still pretty good for certain circumstances now, but not quite as good. Now, the idea is, yes, as you see in this illustration, there's going to be $745,000 that comes back to the family. However, there's no gift tax exemption on that because what we did is we zeroed out this CLAT, another little tool that you use. And so we use the interest rates of the day and that amount goes out to charity. And then whatever's left that might grow in there above and beyond that interest payment is going to be left at the end of the day to go back to your kids. So bottom line is you create this year, you get a giant tax deduction. You put $1 million in there this year, you get $1 million income tax deduction. Why? Well, charity's not waiting for their payment, they're getting it up front. So you get the full thing is a charitable deduction. You're not using any of your gift tax exemption. And then at the end of the term, whatever's left comes back to the family. All right. I know it's a big concept to tackle in 2 minutes, but but these are really for the right family. They're amazing techniques that we can bring out if the circumstances warrant it. So thank you for spending time with me here today and indulging me. And I'm sure you probably saw my face. It was kind of fun. I probably got a little excited and my face is all red because I'm all, yeah, excited. Yeah, anytime, please, if you'd like to contact your advisor and I'm happy to engage in these types of conversations with you, how you can leave a legacy to your community and your family.
And if any of you have questions, please feel free to put them into the chat, and we can. We've got about 10 minutes left, and we can, take on some of those questions if you want to share those with us now. As you're thinking about questions, just want to bring everybody's attention. We know that the election is around the corner, and so we will be having a webinar late this year or early 2025 with our post-election playbook. So we recognize that regardless of which party wins, there will inevitably be changes and things for us to be thinking about as it comes to estate and income tax planning going into 2026 or 2025 and beyond. And so please be on the lookout for that. We will send invites accordingly. And there aren't any formal questions at this point, but Blake, one, I want to say thank you for your passion around giving and really, when I hear you speak, it's really about, and helping clients provide purpose to their money and to their finances, which is an extension of their hard work and their sacrifice. One question I would ask of you, just to wrap this up, maybe you can speak to some of your experiences that tie to either partnering with attorney and client or with, attorney on behalf of client when it comes to executing sort of estate planning in general. I think oftentimes people think about estate plans and they say to themselves, hey, I already have an estate attorney, or hey, my CPA is already giving me tax advice, and in no way are we wanting to separate clients from those key stakeholders in their lives. So maybe you could just speak to how do we partner with the various advisors in a client's life as it pertains to more broadly estate planning, charitable giving, which is a part of estate planning, tax planning, because we're at the center of that for a lot of our clients, and we want to work hard to make sure we're not disrupting something that feels good to them and or come at it from a positive approach. So maybe you could speak to that.
Yeah, absolutely. Happy to. Now, it's important and we're here as collaborative partners with your all of your important planning partners. So, what I've seen, and I was, attorney myself, right? Typically, clients don't want to come into the attorney's office and talk about death. And so when my experience in working with families is that, hey, you know what? They did their estate plan when their children were born, and now their children are 45 years old. And hey, now it's time to update because there's tax law changes. And so what we can help with a lot of different things, but if you haven't seen your attorney in a long, long time, do they have an understanding about what your current net worth is, about what's going on in your life? And so that's where you can play a huge, huge role in bridging that relationship and bringing in the financial picture, because we are probably, as I don't know, Miracle Mile, a financial advisor, probably having 10 times more contacts than your attorneys and CPAs with you and with your family. And so that's where we're here to help collaborate, bring everyone together, because our goal is for the best possible outcomes for our clients. And so that's where if we bring everyone together, we have much, much better outcomes. And then on the top of that is, as the hot button things of today. Hey, estate tax laws are going to change. You need to use your estate tax exemption, and here's a slat. Everyone needs a slat. Well, do they? And so attorneys, they're obviously going to be up to speed. Well, estate planning attorneys are going to be up to speed on what a slat is and what the benefits of that could be. However, where they're going to lack and where we can provide a lot of excellence and expertise in is helping you figure out, if you give away X dollars this year, how is that going to impact the rest of your financial life? Right. And so, if you do some of this irrevocable planning, a SLAT or a trust for the kids and grandkids and the like, whatever you put in there technically are assets that you don't ever want to touch ever again. And so one of the things that we can help do in working with the team is helping make, informed decisions of, okay, yes, I feel good. I can make this gift today and know that I'm never going to have to rely upon, having to use that sometime down the road. And so, yeah, I'm not here to step on anyone's toes. I'm just here to help and collaborate and get this across the finish line for our clients.
Wonderful. One question has come in, so we'll use this question here, Blake. To name family members and a charity in my traditional IRA, would it be cleaner to separate the IRA so the charity gets its own IRA and the family members share another IRA?
That's a great question. However, what I think you can do is leave it all in the same IRA. And here's what I would recommend. And this is, you might want to look at your provider of who's providing the custody for your IRA. But what I like to see in that is be very specific on your beneficiary designation. Say, hey, the first 10% of the IRA is going to XYZ charity. The next 10% is going to, XYZ. And then the remaining 80% is split amongst the kids. So you don't have to segregate it out for two separate IRAs. You can do so in your beneficiary designation. And as we know, as we invest, it's easier if things are together, and it can help to snowball and continue to grow rather than having them be separate. And then, you might not hit break points and things like that. So I just encourage you to take a look, have that conversation with whoever's providing custody, your financial advisor, and we can help work through how you can accomplish those goals through that beneficiary designation. Now, I will say I am a much bigger supporter of a percentage based versus a dollar figure, because, hey, you say, hey, the first $1 million is going to this charity and the rest to the family. Well, what if there's not $1 million at the end of the day? So percentages, much more preferred, because there's always going to be a percentage of something, unless it's zero. But we hope to not get there.
Great. Well, Blake, let's end it there. Thank you so much for your expertise and, most importantly, your desire to support and help our clients. To all of you, thank you to our clients for joining us today. We are privileged and honored to be in this journey with you and serving alongside our advisors as we try to help you navigate your financial futures. To our partners out there, thank you for your support of clients, and we look forward to continuing to work with you and supporting our clients together. Have a great rest of the week, and we look forward to talking with you later this year or first of 2025 with our election playbook. Take care.
Bye, everyone.